Volatility, a double-edged sword, as we've seen from Credit Suisse. They make that point, but clearly the positives for the banking sector are also clear, aren't they? From the start of 2018, the positive update we've got from Credit Suisse in relation to revenues on trading.
Yeah, trading all of a sudden might go from a bit of a cost drag to a profit center for these banks, and you get some volatility in markets. It increases trading definitely by its nature. If you get volatility with an uptrend, that's the ideal situation for the banks. So banks are our preferred sector right now. It's a sector that's trading at tangible book value in Europe. You're getting a dividend yield on the French banks that we own primarily, 4%. Trading at 10 times earnings. Compare that to the rest U.S. equities at 18 times earnings, 2% dividend yield, 3.5 times book value. Very good value and beneficiaries of, we think, what will be probably some steepening of yield curves, and you might get some interest rate margin on that all of a sudden as well.
Geraldine, do you expect, or are you worried that actually the volatility that we saw last week in VIX and equities will spread to the credit market?
Well, I suppose you would need fundamentals to be affected to really affect credit market and default level. And so far, I would say that the volatility is contained to the market. There's a technical element to it. We do not feel the need to revise any of our forecasts. Of course, what we've been looking at are valuations. Valuations are, were not as attractive lately, and we had been recommending to somewhat reduce exposure to credit. But so far, when looking at fundamental developments, there is nothing that would point to us having to change our forecast in any way, be it growth or inflation.